when the world was teetering on the brink of collapse. The general consensus on Wall Street and talking heads on YouTube and everywhere else all thought the world was going to melt down. And Joseph, you said that there is no market crash coming, and here is why. People thought you were an idiot. And you were right.
You know, I think people oftentimes think that the future looks like the past. They traded through 2008, tremendous crash, that was bad. In 2020, tremendous crash, that was bad. And one of the big changes, big fundamental changes that is happening in the world is what's happening with fiscal spending. And that changes all the relationships going forward.
I believe everything changed since 2008. So what is different?
So we had a regime shift in 2008. I think post-COVID is also another regime shift, less about the Fed, more about the fiscal policy.
If we identify a crash as something happens to my standard of living, it's going to crash down, you would say I lost my job, I took a lower paying job, or my business doesn't make as much income. But that can also happen on a crash up because prices go up so fast, I can't afford the vacations and go out to eat as much.
And I think that's happening right now, Mark.
Right.
So they're all saying that things are getting worse, they're unhappy. Now, what could be the reason for that? Now, if you have assets, if you own a home, if you own stocks, those have gone up a lot. But the crazy thing is that if you look at Fed data, about half the population barely has any assets at all. They're basically being left behind.
Right. Which is a bigger risk.
It is.
Because you don't get a reset, you don't get a chance to get back in. All right, Joseph Wang, the Fed guy, the guy that knows the inner workings of the Fed, a Fed trader, worked on the Fed trading desk, trading treasuries and reverse repo and so forth, and now you help educate people on what's going on with the Fed window.
Exactly. Thanks so much for having me, Mark. It's a pleasure to be back here. And it's great to meet in person. We're doing this in person at least. Yeah.
So the last time we talked, you said something, and you said that this was in, I believe, October of 2022, when the world was teetering on the brink of collapse. The general consensus on Wall Street and talking heads on YouTube and everywhere else all thought the world was going to melt down. Harry Dent was calling for a 90% market crash, if you can remember back in October 2022. And Joseph, you said that there is no market crash coming, and here is why.
Right.
And people thought you were an idiot. The comments on that YouTube video that I put up, people were just like, this guy has no idea, this guy's an idiot, this guy doesn't know what he's talking about. And you were right. Now, I learned, or the saying, I think it's Mark Twain, he said that it's not what you don't know that gets you in trouble, it's that what you know absolutely for certain. And I could tell by those comments that everybody was absolutely certain the market had to melt down, but yet it didn't. So what I want to do is let's just recap that a little bit. What you were thinking then and how things played out, and then let's talk, let's see what your crystal ball has to say about the future.
Yeah, so you know, I think people oftentimes think that the future looks like the past. And so when you're talking about people always looking at the crash, it's because they're thinking that the future will look like the past. So a lot of people today who've been in markets, they traded through 2008, tremendous crash, that was bad. In 2020, tremendous crash, that was bad. And so when you fast forward to, say, 2022, or when the Fed was hiking rates aggressively, people were often thinking that as well. But sometimes, you know, the future does not look like the past. And one of the big changes, the big fundamental changes that is happening in the world is what's happening with fiscal spending. And that changes all the relationships going forward. Now, when you think about the markets just the past couple years, you'll notice, well, rates, multi-decade highs, Fed has hiked to 5.5%, and yet the S&P 500 is making all-time highs all the time. If you look at housing, you'd think that having 7% mortgage rates, well, that's going to kill the housing market, right? No, housing prices continue to make all-time highs. Look at prices of gold, you'd think higher interest rates, stronger dollar would hurt gold. That's not happening at all. So something is different, and I feel like a lot of people are still fighting the last war and not fully understanding just what has changed in the world, such that these relationships going forward will not be the same as the past.
Yeah, Albert Einstein was a professor, and every year he would give out the same test to his students, and he had his assistant or whatever one time came up to him and said, Einstein, you know, kind of scared to confront him, but I'm not sure if you're aware, but you just gave out the same test that you gave out the year before. And he said, yeah, so? And the assistant said sheepishly, but don't they have the answers from last year, like they could cheat? And he said, the answers have changed. Because we've discovered new things.
Yes.
We've discovered new things. We made the best decision we could at that time with the information we had, but now we've discovered new information, so the answer's changed. And I think that's what you're saying.
Yes, exactly. I think that's part of the reason why this whole people get confused all the time, and the entire school of macroeconomics is often wrong. When you're looking at things, social things, markets or economics, relationships change over time. It's not so much, sometimes it's because we have new information, sometimes it's just behavioral, different cultures. So that's what makes this so different from something like physics. Now, if I am dropping a ball today, it's going to fall at 9.8 meters per second square, no matter where I drop it, here or London, here or 1,000 years ago. But when you're looking at things in the social sciences, in markets, in macroeconomics, relationships change all the time. And so you're exactly right. I think things are different going forward.
So what is different? So I've been saying that I believe everything changed since 2008. And I think that's sort of like this, where it's split time, AD and BC or something like that, right? And I look at it more from maybe the social science, maybe the psychological side of things, where I think that the way central banks interact in the markets changed in 2008. Their willingness to interact, willingness to intervene, and it's only gotten faster and faster and faster since, as well as the introduction of QE added so much leverage to the system that also changed things.
Mark, you're spot on. So 2008 really is, like you said, it marks a watershed event in how the world works. Now, just for some history, traditionally you think of a central bank as being a lender of last resort. So let's say you're a bank, you know, a lot of people asking for money at the same time, and you're short a little bit on cash. You can borrow from the central bank, lender of last resort. There's no panic, everything goes on. But that role of the central bank has expanded enormously since 2008. Now they're not just a lender of last resort to commercial banks, they're lender of last resort to foreign banks through the FX swap line, lender of last resort to primary dealers, lender of last resort to money market funds. So the Fed has been expanding their footprint over the past decade. Now, more recently, in 2020, we saw them make further advancements. So they have this interesting facility, corporate credit facility, where the Fed was basically lender of last resort to US corporations. They also had another facility, the mainstream lending facility, where the Fed was trying to be lender of last resort to mom and pops. So you can see the Fed continually expanding their role, and that has big implications for the economy and asset prices, because you're, in a sense, you're cutting off left tail risk because you know the Fed is going to jump in there and do whatever it takes to make things stable. So that's one thing. But I also think the other watershed event was 2020. So we had a regime shift in 2008. I think post-COVID is also another regime shift, less about the Fed, more about the fiscal policy.
I want to get to the fiscal, but if we stick on the Fed for a second, so a couple things that I just observed, right? So for example, you look at the size and the speed of their impact. So in 2008 and 2006, home building starts were down 26%. They did nothing. 30 months later, when the whole world came crashing down, they finally acted. So today we would probably never see 26% crash in one of the most important sectors without some sort of intervention, but that's what we saw back then. Then most people would probably agree, I'm sure you might as well, that Bear Stearns going bankrupt sort of was that trigger that caused like the banking cascade to come down. It took 7 months to get a $100 billion bailout put together. But in March of 2023, when the banks collapsed, it took 6 days.
Exactly.
So we're seeing the speed at which they're interacting has changed. But also the size. So for example, we had $700 billion TARP bailout, plus the additional was a little bit over $1 trillion, let's say, of stimulus. But in 2020, it was, between Fed and fiscal, which we'll come back to fiscal, was about 11 trillion-ish.
Yeah. So this is a long process that started since the Great Depression. So the Great Depression, widespread bank failures, hundreds of banks failed. And the Fed was, gosh, that's a shame. Wish someone could do something about that. And that lesson, okay, so not doing anything back then made the Great Depression much worse. The Fed realized that was an error, and so fast forward to 2008, they became much more aggressive, putting together these more emergency lending, more, let's say, balance sheet operations there. And so they became more comfortable with the process. And so what at that time was unconventional monetary policy, after doing it for 10 years, became conventional. So to your point, now 2020 comes along, we have another event in the markets, they just roll it out like that without even thinking.
Right.
They have the muscle memory. And it's something that they've learned over the past basically 100 years.
Yeah. So not only the size was faster in 2020, the speed was faster, but then to your point, I believe there was like 13 different SPVs that were set up during that time, including buying equities through proxies in the market.
So I think there was a facility to buy corporate credit. So that was, I think, the bridge that was a little bit too far for a lot of people, because when you're lending directly to private corporations, you get there's credit risk there. The Fed doesn't like to have that. The way they get around that is this process of setting up an SPV. So the Fed is not supposed to be buying corporate bonds, but what they would do is they would set up this special purpose facility, and they would have the US Treasury put down equity in that facility. And then they would lend that facility billions of dollars. So it's the Fed's money, but hey, they're like, it's not the Fed that's lending directly, it's a special purpose vehicle.
Right.
And in case there are losses, the Fed's not going to take the loss. The Treasury put down the equity, they're going to take the loss.
Right.
So that's how they get around this letter of the law. Now, if there is a really serious emergency, I have no doubt that they would do something like that for equities as well. I think that's something in the future, though.
Yeah.
But other central banks have definitely experimented with that. The Bank of Japan, well known for buying tons of equities, buying a whole bunch of ETFs and REITs there, and it's been helpful for their market.
Yeah. And what I'm laying down is the trend, and we're going to come back to this in a minute. But so then now moving forward, so then we had the bank collapse in 2023. We had that bailout, the BTFP put together, another card up your sleeve, so to speak, right? Every time, a lot of these analysts, like I hate to pick on Harry Dent. I've read a bunch of his books. I think his research is amazing, but they just fail to think about how many more tricks they have up their sleeve. Yeah. And every time they think it seems like they're cornered, they just seem to find another way. So they pulled that out, and now they've gone around, I think you just talked about setting up these FX swap lines. So now we have swap lines set up, not just with like our main country partners, but most of the countries now today. I sort of think of that almost like, hey, if my kid's in trouble, they can call me, I'll get them some money. But like, hey, why don't you just take my credit card with you? That way you don't have to call me, you just have the credit card now. Is that a right way to look at that?
So I think the way the Fed FX swap lines are meant, it's largely for the self-interest of the US. So as you know, Mark, we have the US dollar, which is kind of a global system where it's our currency, but it's used all over the world. And that's fine usually, but the thing is, if someone abroad gets into trouble, that actually impacts us. So let's say, for the sake of argument, there's some bank in France who is in trouble. What usually happens is then they will go to the market and try to borrow money and bid up interest rates. That means interest rates go up in the US as well. And so that makes the Fed's job of controlling interest rates a bit more difficult. So in a sense, to try to make sure that they have more control over our financial system so that it doesn't spill over, they go and they make these loans to foreign banks, foreign central banks in dollars, and those foreign central banks then parcel out those loans to other banks. So in a sense, it strengthens the US dollar system by making it less likely to break.
I get that.
Yeah.
But it's also so that the country has it on tap when they need it.
Yeah.
They don't need to go through some long process and fill out some forms and wait for the government bureaucracy to approve it. It's there.
Yes, exactly. It's things happen quickly in the markets.
Right.
If you're not ready to have on standby, then when you get through this process, big bureaucratic process, it could be too late.
Which I understand. So we're building the case, or exploring the case with you, that the way that they're intervening and preparing has been accelerating. And
no, I like that you mentioned the BTFP facility last year. That was also kind of a new frontier that they crossed that they haven't done before. Now, we talked about the Fed indirectly, basically buying corporate bonds, but what the bank emergency lending facility did was it actually allowed the Fed to lend unsecured to a commercial bank. Now, that's not something the Fed is supposed to do. So usually if you are getting an emergency loan from the Fed, you put up collateral. The Fed wants to be secured, right? They don't want to have any credit risk. But what the facility did was they were lending against par value rather than market value. So what does that mean? So if you had a 30-year Treasury security, that's $100 par value, so you're going to get $100 back at the end of 30 years. Well, interest rates have gone up so much, the market value of that is probably 60 cents on the dollar. But if you use that and you borrowed against it at the BTFP facility, you could actually borrow $100 against par value rather than the market value. And so what happened to that extra $40 without secured? That's unsecured lending. Now, to your point, Mark, that's not something the Fed in the past would have done. They've been expanding their toolkit and pushing the boundaries.
Yeah. So this shows that they're psychologically where their mind is at, where they realize that there's all these types of landmines and triggers that could collapse the system, and they're preemptively trying to plug holes before the holes are even coming up.
They're very conservative that way. They saw 2008, so like you just mentioned, in 2020, in a matter of days, you had the bazookas come out.
Yeah.
Just unbelievable amounts of cash pumped into the system.
Now, because we're in a debt-based monetary system, the dollars become the liability and the debt becomes the asset, right? So the sovereign debt is now the asset that then is used as collateral for even more debt. Is that right? So then the more debt that becomes in the system, the more levered up the system is. So then now with the introduction of QE in 2008, and then of course now what we've seen through 2019 and 2020 and now 2023, the system has gotten much more levered than it was 2006.
Yes, but I would make a difference between private debt and public debt. Now, private debt, there's a chance of default. You could lose your money, and that could cascade into something that's very unpleasant. But if it's public debt, if it's treasuries, there's no default risk there. Fed has a money printer, there's no default risk there. So I'm not as concerned about the rise of public leverage when it comes to financial stability. There are a lot of other bad things about it.
Yeah, but when people buy public debt and it loses its par value as per the banks, that causes a big problem.
Yeah, you're right. There's that interest rate risk there that I think a lot of people who should know better did not account for.
Right. So, I mean, what I'm just trying to get at is, or try to understand, I should just say, is that, again, seen as this introduction of QE in 2008 showed that they want to work differently in the market, preemptively in the market, rather than reactively, but preemptively. But also, it seems like the system has gotten levered up additional as well. And so then I think that, back to the answers have changed, a lot of times drawing conclusions from what happened in 2000 or in the 1970s or in the 1940s doesn't really give us an accurate picture, because sure, inflation was high and sure, the GDP growth was slow, but we didn't have this leverage in the system. So one, we didn't have the attitude of the Fed, but more importantly, we didn't have this debt system that we have. Would that be accurate?
Again, I draw the distinction between public debt and private debt. Public debt, it's an asset to the private sector, like you mentioned before, and it's not something the government ever has to pay back. They can roll it over forever. So I would think the increase in public debt actually increases the net worth of the private sector. It has a deleveraging impact by adding more net worth, more assets. Now, private debt though, that's a problem, because unlike the government, we don't have money printers, and it's possible that a private borrower could have trouble servicing their debt. That could force them to sell their assets, deleverage. That could be disorderly. So I think on the private debt side, it actually seems okay. Most importantly, the banking system after 2008, tremendous amounts of regulation, made it a lot less levered, so that's a lot less concerning. You have other pockets, maybe private credit, that become more levered, but let's say looking at households, for example, a lot less leverage. Net worth is actually at all-time highs, and on top of that, a lot of people have mortgage rates where their cash flows are really, so their net interest expense is low, so that really helps their cash flows. So looking at the private side, I'm not really worried, and the public, in part because there's so much public debt, that actually adds to the net worth of the private sector.
Okay, so on the Fed side, you see that they have certainly shifted their psychology around the willingness to intervene in markets and bail out. The response time and the size of the responses have definitely gone up. Would you say psychologically that why would they just pump in 10 or 20 trillion into the market to save it, to just let it go away now?
No, listen.
I mean, is there
I think
sunken cost fallacy? And what I'm saying is, if there was hypothetically another big crash of 50, 60% next year, do you think they would just go, oh, well, okay, well, we tried 10 trillion last time, it didn't work? Or is it sunken cost fallacy where they're like, well, shoot, we can't let it go now, let's keep going?
Yeah, we'll keep going.
Yeah.
One of the striking things that I've seen the Fed is that they've just become so eager to intervene, even when it doesn't really make sense. A good example is in 2021, house prices were going up 20% a year, but you have the Fed buying hundreds of billions of dollars in mortgages. How does that even make sense? I mean, is 20% a year appreciation not high enough? So again, I think the bias is always for them to do more, do bigger. That's kind of what they know.
Yeah, okay. Now, back to the what we started out with, and you talked about houses making a new all-time high, S&P 500 making a new all-time high, gold making a new all-time high, which doesn't make any sense in this market environment.
Exactly.
But yet, here we are. And what you were saying is it's probably not about all this Fed stuff we were talking about. You think it's really coming from the fiscal side, which is the government spending.
Exactly.
So we have a government that just cannot stop spending. I believe, Biden's new budget for next year, starting in October, is like 7.3 trillion, which is, what is that, 45% more than it was in 2020?
It only goes up.
Right. It's like 50% more spending than we were just a couple of years ago. And they can't reduce that. And so that's like a new baseline, but yet the CBO projects that it even keeps going up from there.
Yeah.
So that is the main driver. This is the fiscal dominance.
It could be moving towards that direction. I think what's important to understand is what it means when the government is spending more than it takes in taxes. So for you and I, we can't really, so when the government spends more than it takes in taxes, it basically issues debt, right? So it prints treasury securities. Now, if you or I were spending something more than we take in, we can also take on debt. The difference between our debt and the government's debt is that the government's debt, in a sense, it's very much like a form of money in the financial system. So if I were to give you $1 billion in treasury securities, that's credit risk free, it's from the government, it's very liquid, you can easily pawn it off. It's kind of like $1 billion bill that pays interest. So that's what's special about government borrowing compared to us. Now, if I give you $1 billion IOU from Joseph Wang, I'm telling you it's not going to be worth $1 billion.
Yeah.
So when the government is deficit spending in this way, it's basically printing dollars. And printing dollars, like you mentioned, at an astronomical rate, $1.5 to $2 trillion a year going forward. And like you rightly mentioned, the CBO, very conservative organization, they can only do projections based on current law. So they're looking at the law, what's written on the books, and it doesn't get better. It actually gets a lot worse. So much worse that the IMF actually has a special section devoted to the fiscal situation in the US, that it's going to be a disaster. And we can talk about why it can't be fixed, but basically it can't be fixed.
Yeah, so I think you made a comment that we're in a runaway situation.
Yes.
Right, that's what you called that.
Runaway situation.
A runaway train? The Fed's on a runaway train?
Runaway train. Yeah. I think Lynn Alden has a really good meme on this, but yeah, it's basically a runaway train. So the fiscal deficit, based on current law, is expected to be 6% a year, basically forever. Now, it's helpful to break that down into three components. When you're looking at government spending, one part is mandatory spending. The second part is net interest. The third part is what they call discretionary. Now, mandatory, that stuff is Social Security, Medicare, Medicaid. There's no way anyone can touch that. And that's only going up because our population is aging. More boomers are taking in more Social Security. And of course, medical costs go up as well. So that's going up. Nothing you can do about it. Interest cost, the United States is not going to renege on their interest payments. That's going up with higher interest rates from the Fed and also higher stock of debt. So that can't be changed. The last thing that could kind of be changed is discretionary spending. And what that is military spending. And
that's probably going up too.
I think that's going up too. Looking across the world, there are a lot of people in Washington who seem to me like they like to fight wars. They're always looking to fight wars.
Well, Eisenhower warned us about the military industrial complex.
And I wish more people took heed of that, but it looks like
the G7 said that they needed $10 trillion to replenish the military. 10 trillion.
Gosh, why don't you just say 100 trillion? We'll meet halfway, right? So it's just an enormous amount of money. There's no way that this military spending is going to go down. So I think that's going to go up as well. So that 6% fiscal spending deficit, I think that's an underestimation.
And then there's a reflexive or doom loop that's baked into this, right? So then they borrow more, which then means more interest on the debt, which means that there's a bigger deficit, which means they borrow more, which means there's more interest on the debt, which means they borrow more. So then
Yeah,
it's sort of
that is the crazy doom loop, like you mentioned. No, this is actually something that economists have thought about over the past decade. There's a really famous paper by Sergeant Wallace who talks about this. It's titled Unpleasant Monetary Arithmetic. And he's saying that, if you have this out of control fiscal spending and you are a central bank that wants to control inflation, what you would do actually is you would cut rates simply because it saves on the interest expense. Actually, President Truman in the 1950s was making this argument that, hey, Fed, you can't raise rates because if you do, our interest expense would go up. So like you note, there is this doom loop aspect. Maybe in the future we would have to cut rates to decrease government spending. That'd be pretty crazy, but it looks like we're heading there.
That will have to cut rates. But there's a lot of other tricks they have up their sleeve. You talked about this yesterday. They can get the banks to buy more treasuries. I believe they were just talking about changing the reserve requirements of banks again.
Oh, there's so many tricks. So when you're talking about huge deficit spending, who's going to buy our debt? That's the least of your worries. There's so many tricks up their sleeve to make that happen.
So does that mean, real quick, all the talk of the rise of the BRICS and they're going to start their own currency, and that's sort of a little bit of nonsense, I would say, and you probably agree with that, but you can correct me if I'm wrong. But really, it does seem that there's potentially a threat, specifically with the sanctions going on with Russia and China, and now let's say China trading for oil in yuan, and then the excess being, instead of being recycled back into U.S. Treasuries, now being recycled into gold.
Yeah.
So let's say that these nations, the BRICS nations, the Russia, the Chinas, et cetera, say, we're just not going to buy as much treasuries because we're afraid you're going to steal them from us again, just like you did to Russia.
Yeah.
So we're just going to put our excesses into, we'll keep them in the oil, we'll buy more commodities, we'll put them into gold, and then those buyers for treasuries go away.
Right.
So a lot of people think that starts to put the U.S. into a bad situation. Are you saying not really, because there's people that the buyers is not a problem?
Yeah, I'm exactly right. So what you're noting is exactly right. So there's this new study from the IMF, super interesting. They looked at a whole bunch of countries in the world and they tried to group them together into different blocks based on how they voted in the UN. They're saying that the China block really is fewer dollars, more gold, more other stuff. So that is definitely happening. It's happening slowly, but it's clear. But I don't think it's a problem for the Treasury market because the Fed, at the end of the day, can always buy it all. And if not, the commercial banks can be strongly encouraged to by changing regulations. That's what happened in the 1940s. You had banks basically buy, 1940s, about 50% of bank balance sheets their assets were in treasuries. Right now, it's a small fraction of that. And back then, they even had something called yield curve control, where basically the Fed would say, long bonds cannot go above 2.5%. If they do go above that, we'll buy them. And so they kind of put a ceiling on interest rates, so they could do that too. Again, at the end of the day, the dollar system, it's just numbers in a computer. Fed controls the computer. That's not the part of it that I would worry about.
Okay, so what is the part of it that you'd worry about?
It's the inflation part that you can't. The financial economy, numbers in a computer screen, you can change that easy. But the real economy stuff, higher inflation, that's much difficult to get rid of, and you usually can't get rid of it without some significant economic pain, and that's difficult unless you have the political support to do that.
Do you believe in the Austrian, or I guess maybe Milton Friedman's view of inflation, which is always a monetary phenomenon?
I think there's some truth to that, but I mean, let's think about that a little bit. Let's say that I have a whole bunch of money, but I keep it locked in this room. I like it in dollar bills. I swim around in it like Scrooge McDuck. That's not going to be inflationary, right? So it does depend on what you do with the money, who actually has it, how it's spent. But having just a whole lot of money, a lot of purchasing power, all things equal, I think does put upward pressure on inflation.
So then you're generally in agreement that increasing the money supply increases prices?
I would say that with one caveat. The money supply also includes things like treasury securities, which are very much money-like asset, like I mentioned before, kind of like money that pays interest.
Yeah. I think part of what the government does, any government through all of history, has always been it's always been about controlling the narrative. We can pull any numerous accounts out of history on this, but it seems like one thing that the government has done is they've sort of changed the definition of inflation. So today they talk about a CPI, consumer price inflation.
Yeah.
I still believe in inflation being like a balloon, inflate a balloon. I'm increasing the volume of air in a balloon, inflating the money supply. I'm increasing the volume of money in the money supply, the units of money in the supply. The price is going up as the result of doing that, but now we're calling inflation CPI, consumer price inflation. And I think part of the reason, and this might be a conspiracy theory tinfoil hat, but like, they've obviously done that. So now it's inflation is CPI, gas, shelter, food, et cetera. But consumer price inflation is not real inflation. And the reason why is because not all prices move up and down at the same time. And so then what happens is they're like, the government can be like gaslighting you or whatever. And it's like, well, look, TVs went down and travel went down. Meanwhile, gas and your housing went up. Well, look, all these prices are going up and down at different times. We don't really know what's going on, which a lot of politicians you see today saying, well, we don't know why prices are going up. So it becomes this like ambiguous problem that's not clear and it's not easily definable because prices don't go up at the same time. Some go up, some go down, and they shift you to that and they can win that. And almost nobody, most of these politicians today, they don't look at the money supply as being that cause.
So I definitely think that, there's definitely a lot of gaslighting. I think we've moved from, it's the economy's stupid to the economy's fine, you're stupid, right? As someone else recently said. So the Biden administration, obviously up for re-election, wants everyone to feel good, wants everyone to think the economy's good, so there's going to be some gaslighting. Now the CPI index you mentioned, well, what we put into this basket of inflation metrics changes over time.
Yeah.
Sometimes, they change it and inflation looks lower. Once upon a time, they included mortgage rates in it, but guess what? Mortgage rates went up when you raised the interest rate. So they kind of took that out and made things look a little bit better. So
the whole basket's a scam.
It's everyone has a different basket of what they consume, right? In California, your housing is going to be different from someone in Springfield.
But even the
Illinois
housing, right? So housing is 30% of the basket, right? Roughly 30ish.
Right.
And how do they calculate that?
Exactly.
Well, they supposedly they
right.
call homeowners and ask them what they think they could rent their house for. I own multiple homes. I've never been called once. Now they could just go to like rent.com, who indexes the rents across the whole country and get an accurate number, but they don't do that. They somehow just call random people, apparently.
Yeah.
Now, and the numbers are like way different than what you see on rent.com, which actually indexes the rents, which is pretty interesting. That's just one example. We could go on, but that's 30% of the basket. They showed, was it a quarter or two ago, the biggest drop in CPI was healthcare costs went down. What healthcare costs? Everybody's insurance went up. Like, where did they get that number from? And that's even before the manipulation of what goes into the basket.
I think that's a big reason why there's such a disconnect between what the economists are saying, inflation's coming down, everyone should be happy, and what the public is saying, that we're not happy. Because this inflation index, it's not well constructed. For a lot of people, it doesn't represent what they consume every day, and so I think that's a big cause of this public disconnect. Now, I like the point that you make about our elected officials seemingly not knowing what they're doing, what's causing all this inflation. I think it's a big problem in that I think the competence of our government today is just much, much lower than it used to be. I get the sense that our forefathers built these great institutions, they built them so well that they just worked, that anyone can run them, and now anyone does run them. And now that we have these challenges, they don't really know how to adapt to that. So I think that's part of the reason why I don't think things are going to get better.
Now, speaking of our forefathers, they were amazingly smart, and people will as a whole, people would just never be that smart again, and partly because all they did was read books and debate. That's all. That was what they had. They had no TV or anything, right? And now today with our TikTok, like short-term attention span, right? But our founding fathers gave us many warnings about banks and central banks specifically, many warnings, and how they were more dangerous than a standing army. As somebody who worked inside the belly of the beast, what's your take on that?
So I think that my impression of the Fed they were just
the warnings that we were given, and were those warnings valid?
I think from the private sector it gives too much credit to the Fed. Honestly, they're just regular people. paying mortgage, bumbling along. I don't think there's any malintent or some kind of conspiracy. Honestly, that's
No, call it ignorance, call it stupidity, call it whatever.
Yeah.
To the point of the founding fathers, they warned us that the central banks were more dangerous to the American people than a standing army. They said that at the rate the standing armies will, or the central banks will go, your kids will one day wake up in a land that they own nothing of. There's numerous warnings. I can't recite them off the top of my head.
Well, I mean, depending on, so listen, if you were living in Jefferson's world, we would all be farmers hanging out on the farm, right? So a vision of the world a few hundred years ago is not necessarily in line with the world we are in today, with all that we know in our technology and so forth. What we did learn over the past couple hundred years is that central banks can be helpful. We had two, right? Andrew Jackson got rid of the second one. And then finally, we decided that actually there are good things about central banks as well. They can help us fight banking panics. So if you look across the world, all their countries, they have central banks.
Do they fight banking panics, or do they put out the fires they start?
So there were fires before there were central banks, right?
There were fires before there were central banks.
So,
how were there fires before central banks?
So central banks arose because there were fires.
Let's talk about that.
Sure.
So you're talking about the era of free banking in the late 1800s?
Yeah, so every now and then you would have a panic, right? So you sometimes the private sector could bail them out, like JP Morgan, the real JP Morgan person, bailed out the banking sector in New York in the early 20th century. But you know, what they thought could be even better was to have this institution who could actually...
JP Morgan thought it would be better because he had a lot of public backlash against him. And so what he thought is, well, if I create this conglomerate of banks that I take myself out of, then there'll be more public support for that. If we go back to the era of free banking in the late 1800s, where banks were going boom and bust and people were losing money, that was true. That's one thing that happens in a private market, a free market. But the problem in the free banking era was there was no free market. And so government regulations prevented free banking from working. So for example, the free banks, the banks in that era, they couldn't have more than one bank. So like I had one in New York, but I couldn't have one in Louisiana.
Right.
And each bank would create their own currency. So we had all these different currencies. And then what would happen is I'd take the bank from currency from one bank, but then when I go to Louisiana, nobody wanted that currency, so I'd have to give it at a deep discount. And that's no different than when I go down to Mexico. If I'm in the main town of Mexico, they'll give me about par for my dollar. But if I go out into when I go surfing on a remote beach, they don't want that dollar. They're going to give me a massive discount to that because now they have duration risk and when can I go exchange it, right? And so that's sort of what happened in the free banking. So that kind of crippled the banking sector, but the bigger problem is the same thing that happened to the free banks, the same thing that happened to SVB in 2023, is the banks were forced to buy those government bonds that became worthless, and a lot of them caused financial hardship for them. So back to, did they put out a fire that they started? And then that argues is the Fed and the government the same, I suppose.
I think there's any institution, costs and benefits, right? There are probably things that are good. If we just had free banking, banks issue their own currency, maybe there would be more of a self-interest that the banks would make better loans, no one to bail them out. But as a society, I look at this as a big social experiment, right? We each have different things that we do, and some work and they stay, and some don't work and they go away. Now, this central bank thing that we've had seems to work, and so it's still here. And it's true across the world as well.
There's a chart I've used many times before, and I was going to see if I could just find it real handy here because I want to show it to you. It's a chart going back.
I might have seen it before.
It's a chart going back to 1800, and it looks like this. And it basically shows booms and busts. 1913. You ever seen that chart?
You think the booms and busts
each boom and bust has gotten bigger since we crossed that date of 1913. And you think about it, Joseph, right? So like if I'm carrying 2 books in my hand, it's pretty easy to carry 2 books in my hand. If I stack 200 books, like, whoa, how do I balance that, right? So every time we increase the monetary supply, these are going to get bigger and bigger and bigger. I have the chart.
I'll take a look at it. That just strikes me as, I would think that having a central bank, you would have less panics. So. But there are a lot of other things happening in this time as well, right? You had, 2 great world wars that impacts the business cycle as well. Later on, you also have, going off the gold standard. That
Yeah, I don't have the chart handy.
Okay.
I'll find it, send it over to you.
No worries.
But let's go back to, we're kind of running out of time here. So back to the runaway train.
Yes.
Really, the Fed's just bumbling along. Maybe that you said that was your words. And the fiscal thing is maybe the runaway train. So
Yes.
the government spending, the CBO sort of projects maybe conservatively where things are going. I showed you some charts yesterday, and I'm not going to hold you to it because I know you haven't really had time to review them, but total global liquidity mapped over the S&P 500 at like a 95% correlation, which is pretty interesting. And so it does seem like as this spending, as this liquidity continues, it's pushing asset prices higher. So back to why are houses, S&P 500 and gold making new all-time highs? Maybe it's the liquidity, stupid.
Maybe it's the dollar that's depreciating.
Or maybe,
that's
that's what I said to you.
That's the story.
That's what I said to you. I said, maybe it's not a bubble in asset prices,
Right.
it's a bubble in the denominator.
Exactly, Mark. And you've been on top of these liquidity metrics, and they seem to be related to higher asset prices, right? So I look at the source of this. So from my framework, I look at the source of this as fiscal spending, printing trillions of dollars a year, not going to stop. So I think the end result is that we crash up. So the risk right now, I think, is that things go higher than anyone expects them to. In the past, we would always be afraid of left tail risk. What if it crashes? This time, I think you also have to be aware of what if it crashes up.
Yeah. A crash up. Now, if we identify a crash as something happens to my standard of living,
Right.
so typically in a crash down, a left tail risk, a crash down, you would say I lost my job, I took a lower paying job, or my business doesn't make as much income. In either case, I can't take as many vacations or go out to eat as much. So my standard of living went down.
Yes.
But that can also happen on a crash up because prices go up so fast, I can't afford the vacations and go out to
And
eat
I
as
think
much.
that's happening right now, Mark.
Right.
So let's look at what the consumers are saying through polls. They're all saying that things are getting worse. They're unhappy. Now, what could be the reason for that? I think it's exactly as you described. Now, if you have assets, if you own a home, if you own stocks, those have gone up a lot. We've seen that the past couple of years. But the crazy thing is that if you look at Fed data, about half the population barely has any assets at all. And so those people, they're seeing the cost of everything they purchase go up. Their wages have gone up a bit, but for many people, they haven't caught up with the rising prices. So for 50% of the population, they're basically being left behind.
Right.
So,
Which is a bigger risk.
It is.
Because you don't get a reset, you don't get a chance to get back in.
One of the things about the Great Depression in the 1930s, it was a great reset. Basically everyone was reset. And after that, we had, decades of, I guess, a more egalitarian and maybe a more harmonious society. There's less inequality for sure. So yeah, there's no reset in this situation.
Yeah. Now, how does this end, Joseph? So let me phrase it up the way I think and put some context to this. So, again, the left tail risk, everyone's waiting for the big crash.
Yeah.
The 90% crash, Harry Dent's calling for, it's coming, the 90% crash. But it seems like what under Keynesian economics, or maybe MMT now, the central bank is there to ease the booms and busts, and they do that with debt.
Right.
But the law of diminishing returns shows us that we're not getting the same amount of growth for the debt anymore. And last I had looked, we're getting about 40 cents of growth for every dollar of debt. And then it seems like eventually we get 20 cents of growth, and then 10 cents of growth, and then maybe we get no growth for a dollar of debt. So I've kind of been in the camp that things go out with a whimper, not with a bang. But we're on a runaway train.
What do you mean by a whimper? Just kind of malaise or in the economy?
Yeah, well, instead of 40 cents of growth, we get 30 cents, and then we get 20 cents, and then we get 10 cents. And we just sort of muddle along, and I think we have plenty of examples of this. So, just look at Argentina, Venezuela, Lebanon, Turkey, Peru. They're all around us. They're all, Zimbabwe, they're all sort of going into this. They're in different rates of inflation. Some you could argue maybe hyperinflation, technically, whatever, 50%, what is it, 50%?
And life goes on there, right? You get used to it, you continue to live and, do the things you do.
But growth completely stalls out.
Right.
Inflation keeps raging, and they just muddle along. And that's what I mean more of a whimper. Like, they're still there. The currencies are still working. George was just down in Argentina, and he said to get a meal, it was like counting like a 20,000 stack, So that's kind of what I think a whimper, not a bang.
Yeah.
So everybody's waiting for this, like, the dollar's gonna crash. It's all gonna end. And that's not my view, but how do you think it ends?
So I think this ends largely through a political process. So what I think happens is as we continue to crash up, there's this disparity between the haves and have-nots just become really wide. And that's going to force some degree of political change. Now, I think we're seeing the beginnings of that. It could be higher taxes. Now, the US compared to other countries actually has relatively low taxes. You know, you hit your max tax rate here in the US, 580,000. Across other Western countries, it's more like 150, 200,000, and you get hit with the highest tax rate, which is actually higher than our highest tax rate. So,
not if you live in California.
The People's Republic of California is separate. So, the way that I think this happens is that we just have this tremendous amounts of social unrest. Eventually, the government does something and gets control of the fiscal situation and inflation through higher taxes and a little bit less spending. Now, what that happens to growth, I think growth is not going to be good going forward either, because in the process of trying to control higher inflation, they're going to have more and more, I guess, administrative measures, trying to control prices, trying to have more regulation. That seems to be the trend going forward. Now, when I think about what creates growth, at the end of the day, it's the hard work and ingenuity of the individual. You have to have some businessman go out, take a risk, create something new. And the way that they can do that is if they have the freedom to, like less regulation, and the incentive to, they have the tax structure in place. Now, that's, I think, a big reason why the US has so vastly outperformed, let's say, Western Europe, where taxes are super high, regulation is super high. Look at, they don't have any tech over there. All the tech, all the new things of the new world from the US. And I think we are kind of, in a sense, heading towards that direction where you just have, in order to, I think, have more control over the economy, the government is just expanding the reach. And so I think that's going to be negative for growth going forward as well. Just how this process plays out, whether or not it's very disorderly, I think we'll.
And when we say play out, let's put a time frame on that. So like,
so
10, the rest of the decade.
The rest of the decade, I think we'll see we'll see the end of this process by then. So I think we are at a point where 1.5% deficit. This is something that just can't be sustained for any more than a few years. Eventually, the investors, everyone will wise up to it. We'll see everything. We'll see all the asset markets inflate hugely, and I think that's going to cause a lot of social unrest, and that's going to, I think, force the change, the political change.
Have you been to the big cities? We might be already close to that. But, but that's another story.
I mean, in California, I'm sure it's some of the leading edge.
I mean, Philadelphia, Baltimore, Chicago. Anyway, okay, good stuff. So when I lived in Puerto Rico in 2021, my best friend over on the island was Cuppy. I don't know if you're familiar with his work.
I've heard Cuppy. Cuppy's brilliant.
And his thing was always like, we're just not long enough. We're not long enough.
I like Cuppy's Project Zimbabwe. That's a beautiful hashtag.
Yeah, and we're just not long enough, like, because he's in the crash up thesis as well. So stay long through 2026, or I'm sorry, through 2030.
That's my thinking. Again, not investment advice, always be careful. It's going to be a volatile ride, I think. But I think the trend is clearly up and higher than anyone expects.
All right. The Fed guy, working from the inner belly of the beast here, and giving you information. So you have some courses on the Fed, courses on the central bank, and some newsletter. Go ahead and tell us about that.
Yeah, so if you guys are interested in learning more about my work, I have a weekly newsletter on fedguy.com where I give you my thoughts on the markets. I also have a YouTube channel. It's called Joseph Wang, where I would debrief you about what's happening in the markets. And again, if you're really interested in learning about central banking, I have a best-selling book called Central Banking 101, and also online courses about understanding markets at centralbanking101.com.
There we go.
Thanks so much for having me, Mark.
Thank you.